What's up, guys? Welcome back. Today, we're going to be going over the accounting equation. And the accounting equation is it sets the foundation for how accountants and other accounting professionals perform bookkeeping. And bookkeeping, the goal of bookkeeping is for us to take a series of transactions over a period of time and categorize them into one of three accounts, being assets, liabilities, or equity. And if you look at, if as you're looking at this screen, you can see here I have the accounting equation in front of you, which is A equals L plus E. And so, just to give you a quick rundown of what each of them are, your assets are what you own, but it's a summation of everything that you own. And so, we want to know where each of these things came from because we need to identify the effects of individual transactions. And we can't do that if we categorize debt instruments and what you actually have, cash, into one big number. So we take that number, your total assets, and we divide it into two different accounts, liabilities and equity. And so just real quick, liabilities is funds, services, goods that you owe to somebody else. Equity is funds, goods, services that you yourself own. And that's it. Without getting into more technicalities or more technical information than what I want to give out in this video, that's really all it is. So individual transactions are going to affect one or two or all three of these accounts at the same time. So like if you look at the first one, right underneath, you can see that we have $100,000 or 100,000 in liabilities. So that represents that at some point, somebody, you or someone representing your business, established a note, a $100,000 note, which increases your cash balance because someone has now loaned you or your business $100,000. So that increase of $100,000 increases the debt you owe, but it also increases your assets by $100,000. You now have access to $100,000 in cash to go do things. Simple. And it's the same thing that would happen. What happened in this transaction is the same thing that happens in the next transaction where you have $30,000 in equity. How you got it, I can't tell you without looking at the transactions. As far as we know, you already had the 30,000. You donated 30,000 to yourself, or you made $30,000 in retained earnings from your operations from that month. But the only way we're going to know for sure where that came from is by analyzing your financial statements. But that's not what this is. This is just a fundamental breakdown of how transactions affect each of these accounts. And so a $30,000 increase in equity also gives you a $30,000 increase in assets. So if you wanted to combine the balances from both of these transactions, you could say that by the end of both of these transactions, your business has gained $30,000 in equity and has established a $100,000 note totaling up to $100,000 in assets, which shows that it's balanced, right? So whatever you've done on the right side of that equation must equal whatever's on the left side of that equation. Okay? So going to this third transaction, now we're looking at some like a more of a compound kind of action. We're increasing one account but decreasing another account at the same time. So just to start from the furthest one to the right, you can see that we lost $20,000. Let's say we lost $20,000 in operations. We didn't do well this month. We lost $20,000 in sales. We're having a bad time. And so at the same time, we also established another $20,000 note to go do things and increased our total debt balance by 100, but increased our debt balance by 20,000. Does this change our total assets? No, it doesn't. Because since we increased our liabilities by 20,000, if that was all we did in that transaction, then we would have an increase of total assets by 20,000, which would make it 150,000, which would be up from 130. But since we lost $20,000 at the same time, we decreased that 150,000 back down to 130,000. And all this transaction says is that we now have more debt than we had before, and we have less equity than we had before, which again isn't by itself a problem. That's not a bad thing. It just means we didn't make as much money, and that could be for a multitude of reasons. But we're not going to know why unless we drill down into the individual transactions to identify where we lost the money. Okay? So let's look at the last transaction here. We have a $20,000 gain in equity, which means we made $20,000 this period. Cool. Or someone invested $20,000 in us. Cool. Great. We're having a good time. Golf clap. But you can also see that we reduced our liabilities by $20,000, which means we owe $20,000 less in total debt. So we don't have as much debt as we did in the last transaction. Is that good? It depends. Because, to pay off debt, you have to have cash to pay it, So that means we spent $20,000 in cash to reduce our debt by $20,000, but our total assets remain the same. Again, 130,000. And matter of fact, all the fourth transaction does is reverse the third. And it takes us back to our status at the end of the second transaction. We have $30,000 worth in equity plus $100,000 worth in liabilities, which equals $130,000 in total assets. And so by looking at transactions and how they change over time, you can identify what a business is doing by a certain point. It's because, when say you're operating your business and you're trying to expand, but you don't want to use your cash to do it, you want to go borrow from the bank their money, go buy, set up shop in another state, and then leverage the profits from that state to offset the negative cash flow caused by the loan. That's when we're getting into complex things. That's why we look at this stuff. We look at this stuff all the time, because what we want to do is identify what each effect, not what each effect, but we want to identify the effects of each transaction over time, because our goal is to establish what transactions are the most profitable for yourself and for your business. If we don't know what those transactions are, we're not going to be able to identify the gains and loss on trades, which is specifically what we're looking for. We want to know where we're making our money versus where we're losing our money, so we know what action to take, what action to invest in versus what action do we try to reduce doing to control. Okay, so without going too much into transactions, that's a subject for another blog post and another video, because that's the real meat and potatoes of this thing. I wanted you all to look at this and kind of have a basic idea of how this works, because when we get into the transactions, I'm gonna have to show you some journal entries. And in those journal entries, if you don't understand this, those journal entries will get confusing. Okay? But anyway, thank you for watching. Like, favorite, subscribe, hit all the obligatory buttons. Don't know what they are, so do your thing. You guys have a good one. Thank you. Bye-bye.